The economic data released by China last week seemed to confirm the country's emergence from the global financial crisis relatively unscathed. 8.7% growth in 2009, adequate employment, a healthy trade balance. It all seems to underline China's safe passage through the turmoil of last year that severely damaged so many other economies. But one top analyst is warning that China may not find things so easy in 2010. Stephen Roach is chairman of Morgan Stanley Asia. He says after years of growth, the Chinese export sector could soon face a backlash from Western countries. Speaking at a forum in Hong Kong, Roach warned that while external demand for Chinese products still exists, demand has slowed amid the global economic shakeup. He pointed to downward trends in consumption by the United States, the world's largest consumer, as one reason for Chinese producers to be concerned. But he says a political agenda in the U.S. could end up being a more substantial issue.
As the U.S. Congress faces the midterm elections later this year, there's going to be enormous political pressure to be aggressive on the trade agenda, and I worry that politicians, both Republican and Democrat alike, will take out their frustrations on China.
Roach conceded that China's economy grew more than any other major world economy in 2009, but he warned that this growth is not sustainable as it's mainly investment-based. Over the past few months, the United States has imposed tariffs on several Chinese exports, and other countries have complained of so-called dumping by Chinese manufacturers. These moves have been widely condemned as protectionism by China's state-controlled media. But Roach did have some good news for China. He says the government's decision to focus on boosting the domestic market over the next 5 years is a sound move, as it could reduce the effects of any major drop in all the important exports that have led to China's phenomenal growth until now. Jeremy Nuttall, BON.